This is the Coins, Cashflow, and Conversations podcast. I am your host, Dakota Grady, hosted by Upstate Essential Solutions. If you need help with accounting and taxes, contact me today at dakotagrady.com. Or if you need help with your personal finances, same website as dakotagrady.com. Hey y'all, welcome to the show. I'm glad you're here. No matter where you are, you can be anywhere in the world, but thank you for joining us on the podcast. Today we're talking about bookkeeping, how it relates to taxes as well. All right, so the what, why, and how of bookkeeping. First, a little background about what I do. So I do accounting and taxes. And the difference between bookkeeping and accounting is, well, I have an accounting degree. I went to school for a bachelor's, 4-year degree in accounting. Accounting is simply the language of business. What do I mean by that? Well, when you make money in the business or spend money in the business, that's basically the information that is bookkeeping. So you have a business, so you're a caterer. You buy some food to prepare to serve your clients, right? And they pay you for the services. Well, the information you record, whether it be income and expenses, money coming in and money going out, is bookkeeping. What happens is you collect all the data and then you put it into a spreadsheet or either a software and you get numbers, right? Or I get numbers. The information that I use, bookkeeping, accounting, or the income and expenses, money going in and out, it's all bookkeeping. When it becomes accounting is where I use that information, put into what's called financial statements, and it tells a story about the business, how much is spent and earned for a particular period of time, and also how the business is financed. For example, you spent, say, $500 on food for your catering business, and you made $1,000 from that money, right, from that event. Well, income, $1,000 minus expenses is $500. So your net income, the gross income is the money you earn before expenses, right? Before you pay anybody else. That's gross income. When you take out expenses, it then becomes net income. So the net income is what a business pays taxes on. It's not gross. It's not the income before expenses. It's income after you pay your expenses, whether it be for advertising, cost of goods sold, inventory. It may be for, well, actually, inventory would be an asset, but the things you purchase to resell. You may purchase hair from a vendor and you resell it to someone. The cost of goods sold would be, all right, you made a purchase for $50 for the hair and you sold it for $60. Well, the difference would be $10, basically. It cost you $50 for that piece of hair, but you made a $10 profit off of the money off of the hair when you sold it. That's what it is, cost of goods sold, basically. The inventory you purchase and the cost you pay for it will be taken out of, it'll be an expense. And it also reduces the inventory for that particular company. So that's an expense. Cost of goods sold is an expense to the business for purchasing a widget to resell, in other words. So you have all your expenses coming out of the income that you earned. And at that point, it becomes net income. So that is called the income statement. It makes sense, or profit and loss. You either have a profit, which means you have more income than you spent. In our example, we made $1,000 and we spent $500 for our supplies. And after taking the expense out of the income, you have net income of $500, right? Now, if it was the opposite, say you spent $1,000 for your supplies, but your customer only paid you $500. So you have $500 income minus $1,000 gives you a net loss of $500. So you had a loss in your business because you had more expense. You spent more than you actually earned. So again, that would be a net loss. That's what's called profit and loss statement, P&L. So you have income minus your expenses gives you a net income or net profit or a net loss. And then the information also translates to what is called the balance sheet. The balance sheet is how your business is financed. For example, you have assets equals liabilities plus owner's equity. I'll break it down for you. Accounting is basically that formula. Assets, everything you purchase. You have cash, account receivable, which is the money you receive or that's due to you from your customers. It's AR, account receivable. That's an asset. You may have vehicles, machinery, equipment. You may have patents. All those things are assets for the business. They are going to give you an economic benefit in your business. So, for example, if you buy a vehicle to transport your clients back and forth to their locations, you may be a company that does transportation, right? Your asset, that vehicle, is going to help you get more income for your business. So the asset is going to give you economic value in your business. So an asset brings economic value in your business over time for your business. Now, the asset is financed by two things. One, liabilities, debt, or two, equity by the owner. If you borrow money to get that vehicle from a bank, a friend, family, credit union, you're financing your business, that asset, that vehicle that's going to produce economic benefit for your company. You're financing that business with a loan, a liability. Or if you say, well, I'm not going to use a loan to finance my business, I'm going to use my own money, your money, your money, your money. That's right. You're going to use your money to fund your business. You will have no debt, but you have an equity. You're putting owner's equity, owner's investment into the business to finance your vehicle. Or if you want to use both, I want to borrow money from my bank and I'm going to put money into my business to fund my assets, I'll do that. So you have your assets, your equipment, your vehicles, your cash in the bank. They're financed by either you, the owner, or a lender. It's that simple. There's more to it, but on a simplified basis, that's what accounting is. It's using the bookkeeping, income, expenses, and all the transactions to tell a story about how a business has earned money, either more or less than it actually has paid out. Income minus expenses. That's how much you either have a net profit or a net loss. And that profit flows or goes to the balance sheet. It goes to the equity section saying your business can be financed by three ways. Loans or liabilities, debt, the owner, you, or the income from the business, because any net profits or losses flow to the balance sheet. So they work hand in hand. The profit and loss statement or income statement or P&L is connected with the balance sheet. It's basically saying that those two statements, they work together hand in hand. You're financing your business by income from the business too. So why is this important? Because without the numbers, without bookkeeping, without accounting, you can't know if you're making money or not. I just told you how to do it on the income statement, right? You want to know how you're financing your business, right? If you don't know the numbers. And if someone wanted to buy your business, how could you value it if you don't have the numbers? And lastly, if you don't do bookkeeping and taxes, bookkeeping and accounting, you can't do your taxes. Why not? Because we, as accounting professionals, as bookkeepers, as CPAs, certified public accountants, as tax professionals, we use the information from the P&L, the income statement to file your taxes if you have a business. It's that simple. And without that information, we cannot do your taxes for you. That's right, we can't do it for you because we don't know the numbers in order to do your tax return. That's why bookkeeping and accounting is important for every business, because whether you're for-profit or non-profit, you need to know the numbers in your business. So we as accounting professionals can do your bookkeeping, taxes, and bookkeeping, accounting, and your taxes. That's right. Because without information, bookkeeping and accounting, we can't do your taxes. And taxes are important. Every business that makes $1,000 or more must pay taxes on the income. That's right. In our example, I use that you made a net profit, that's income after expenses, of $500. Well, that money won't be taxable to you. Why not? Because it's less than the threshold of $1,000. If you made $1,000 or more in your business after expenses, that means you must pay taxes on that money. And I recommend paying at least 25% of taxes to the IRS. For example, you make $1,000 in your business after expenses, do 1,000 times 0.25 or 25%, and that gives you $250, right? $250. Send it to the government every quarter. So every quarter, do your quarterly estimates. Look at the quarters. Let me break down the quarters for you. So January, February, March is first quarter. April and May is second quarter. And then you have June, July, and August is third quarter. And September, October, November, December is fourth quarter. So each quarter, look at your bookkeeping, look at your accounting, your statements, financial statements. Every quarter, look at those statements to see if you made $1,000 or more. And if you have, do the calculation of 25% to pay that to the IRS. And why do I say 25%? I say that because you're roughly going to pay taxes of 10% for federal taxes. If you're self-employed like I am, you pay FICA, basically Social Security and Medicare taxes. Well, if I work for a company, I would pay half of FICA, and my employee would pay half of FICA too. How? Because as an employer, they have to pay half of Social Security and Medicare, and I do too. My half is 7.65%. My employer's half is 7.65%. Well, if you're self-employed like I am, you pay both amounts, which equals 15.3% in FICA taxes. So if you're going to pay 15% in FICA taxes, you're also going to pay 10% in federal taxes. So 10% plus 15% is 25%. That's how I got the 25% estimate for you to do your quarterly estimated tax payments. That's simple, y'all. So I hope this episode was valuable to you. I want to invite you to subscribe to my YouTube channel, share it, like it, comment on it as well, and invite others to join me on the Coins, Cashflow, and Conversations podcast. If you need help with your accounting and taxes, contact me today at dakotagrady.com. And if you're struggling with your finances, I got you covered too. Contact me today at dakotagrady.com. This is the Coins, Cashflow, and Conversations podcast, sponsored by Upstate Essential Solutions. Contact me today at dakotagrady.com.